Hello and welcome to Chapter 13. This is Professor Farhat. In this session, we're going to discuss return risk and the SML, which is the security market line. So let's go ahead and start to take this chapter step by step because we're going to be working with information built on the previous session. So make sure you learn what's expected return to start with and how do we calculate the variance for that. Okay. So in the previous chapter, we discussed how to calculate the average return and the variance using historical data. So this is what we learned. Now we now begin to discuss how to analyze return and variances when the information we have concerns future possible returns and their probabilities. Now, rather than looking at the past, we're going to be looking at the future. So we're going to be looking at something we called expected return. And what's the expected return? It's the return that we expect to earn in the future. So let's go ahead and start to discuss how to calculate what we called the expected return. So we'll start using a simple example to illustrate the point. Consider a single period of time, say a year. We have two stocks, stock L and stock U, which have the following characteristics. Stock L is expected to have 25% return in the coming year, and stock U will have a return of 20%. Okay? In this situation, if all investors agree on expected return, why would anyone own, obviously, U? Because U is only expected to earn 20%. Well, for one thing, we don't know the future. After all, why invest in one stock when the expectation is that the other will do better? Clearly, the answer must depend on the risk of the two investments. So we need to know what is the risk. Yes, one is earning more than the other. The return on L, although it's expected to be 25%, could actually turn out to be higher or lower. So remember, this is an expected. We're saying the expected is 25%. So now we're going to start to build up scenarios to see how we can start to pinpoint what we call the expected return. So suppose the economy, so before we start, remember, let's just have this on the side. We have stock L. Well, we're going to see it down the road. Make sure you take notes that stock L would earn 25 and stock U is 20. Suppose that the economy booms. So in good time, suppose that the economy boom. In good time, we think that stock L would return 70%. If the economy enter a recession, it could be negative 20. So stock L, in good time, it's going to do really well. And in bad time, it's going to be negative 20%. We say there are two states of the economy, which means that there are only two possible situations. So here what we're assuming, it's either the economy is going to have a recession or the economy is going to boom, this is simplified, but we need to make the simplification to illustrate the calculation of the expected return. You could have more than two states of the economy, maybe really good in between and recession, maybe really good in between, not that good and a recession. So you could have all sorts of probabilities, but now we're using only two possible situations. Suppose we think a boom and a recession are equally likely. So we think the boom is a 50% chance and a recession is 50% chance. Table 13-1 will illustrate the basic information we have described and some additional information about stock U. Notice that stock U earns 30% if there's a recession and 10% if there's a boom. Stock U in good time will make 30%, good time, and in bad time, if the economy doesn't do well, it would still make 10%. Notice, it would still positive even in bad time. So now what we're going to do, we're going to calculate the expected return, okay, for a recession and for a boom. And what are we assuming? The chances are equal, the probability. So this is the probability, and the probability column should add up to how much? To 100% or 1. So 50% chance of a recession, 50% chance of a boom. Good time or bad time. This is kind of to illustrate this. So in good time, in a recession, let's start with a recession. In a recession, stock L will do really bad, 20%. And stock U, this is stock L, stock U will earn 30%. In a boom, in a good time, now in a boom, stock L will do very well, and stock U will not do as well. Actually, it will do not as good. So it seems stock U does even better in a recession. Okay, and why? Well, stock U, I mean, we don't want to go any further in this. It could be what's called a defensive stocks. Defensive stocks are stocks that do well in recession, like the dollar store. The dollar store Well, what happened is when we have a recession, people will go and shop at the dollar store because they can buy what they need at a cheaper price. So it's called a defensive stock. So in a recession, those stocks do better. Okay. Obviously, if you buy one of these stocks, say stock Q, what you earn in any particular year depend on the state of the economy. However, suppose the probabilities stay the same through the time. If you hold stock Q for a number of years, you will earn 30% about half of the time and 10% about the other half of the time. So what is the expected return? Well, think about it. You could have 50% boom, 50% recession. So this is the recession probability and this is the boom probability. So the expected return, so how do you compute the expected return? You take the probability, this is the probability, times the percentage in that probability, and you could have more than two. We're just keeping it here simple. This is the probability times the percentage. So if you do this, you would calculate the expected return of 20%. So in other words, you would expect to earn 20% from this stock on average. Now, obviously, those probabilities, they could change. It could be here, for example, 30 versus 70, or 60 versus 40. Okay, they have to add up to 100%. Keep that in mind. The probability will have to add up to 100%. For stock L, so how did we come up with the 25%? The probabilities here are the same, which is 50 and 50. But in a recession, you will do very bad. In a boom, you will do very well. And that's going to give us an expected return of 25%. So let's keep going here. So let's summarize everything that we did in a table here. So here we go. In a recession, the state of the economy, the probability is 50% of that happening. Stock L, rate of return, if the state occur, is negative 20. So if we'll take 50% times negative 20 will give us 0.1. In a boom, which is a 50% chance, we could earn up to 70%. That's going to give us positive 35. Negative 10 return, positive 35 will give us expected return of 25. Stock U now, the other stock, again, the probabilities are 50%, so we're done with this stock L. The probabilities are 50%. We'll take 50% times 30% in a recession. It seems this is a defensive stock. What's going to happen, we are going to earn 15%, expected to earn 15%, expecting a 50% a recession happening. Okay? Now, if we are in a boom, which is a 50% chance, if that happened, we earn 10%, so 50% times 10%, it's going to be 0.05, which is 5%. 15 plus 5, the expected return is 20%. The expected return is 20%. Now, if you remember what we did in the previous chapter, we defined the risk premium as the difference between the return on a risky investment and that of a risk-free investment. And remember, we talked about the T-bill as a risk-free investment, and you remember the rate was 3.5. And we calculated the historical risk premium on some different investment using the projected return. We can calculate the projected or expected risk premium as the difference between the expected return on a risky investment and a certain risk-free investment. Basically the same thing, but what we're doing here is we are working with not the actual return, the expected return on a risky investment and risk-free investment, whatever it's going to be. We're going to assume it's going to be the T-bill. So suppose risk-free investment that are currently offering 8%. So now we're going to assume that the risk-free investment is 8%, and that's very, very high. So we can say R of F, which is 8%, the risk-free investment is 8%. Given this, what is the projected risk premium on stock Q? Well, stock Q, remember, stock Q is expected 20%. So stock Q is earning 12% above the risk-free. So the risk-free we're assuming here is 8%, which is pretty high. Remember, it was 3.5 in the prior chapter. We're assuming it's 8. And the expected is 20. So we'll get the expected return minus the risk-free will give us risk premium. And we can do the same thing for stock L. Stock L is expected to earn 25%. Take out the risk-free rate, which is 8%. So stock L is earning a risk premium of 17%. In general, the expected return on a security or other asset is simply equal to the sum of possible return, so the probability possible return multiplied by probability multiplied by the possible return. Again, keep in mind that when you do the probabilities, they should add up to 100%. So you could have 20, 20, 30, that's 70, and another 30. So you could have 4 probabilities, and 10%, 10%, 15%, and 10%. So it doesn't matter, but the probabilities will have to add up to 100%. The probabilities have to add up to 100%. So if we had 100 possible return, we could multiply each one by its probability and add them up to the result. The result will be the expected return. So this is how we compute the expected return. The risk premium would then be the difference between the expected return and the risk-free rate. Now let's work another example with unequal probabilities, because in the prior session in the first example, what we did, we assumed that the probabilities are 50-50. Let's change this. Let's change this probability. Let's take a look at this example. So suppose you think a boom will occur only 20% of the time instead of 50%. So now the probability of a boom is 20%. This is the probability. What are the expected return on stock Q and L in this case? Well, the boom, then obviously the recession should be 80% because they have to add up to 100%. What are the expected return on stock U and stock L in this case? If the risk-free rate is 10%, what's the risk premium? So the first thing to notice is that the recession must occur 80%, which already I told you about this. With this in mind, we see that stock Q has a 30% return in 80% of the time. So in 80% of the time, so if we're looking at stock U, we're going to take 80. So this is the recession, 80%. The boom is 20%. So what we do is we're going to take, in a recession, stock Q will earn 30%. In a boom, stock Q, remember, it's a defensive stock, it's going to earn less, 10%. So now what we do is 80 times 0.3 and 20 times 0.1, when we add everything up, it will add up to 0.26 or 26%. So this is the expected return on stock U. Now you could do the same thing for stock L. And for stock L, remember that in a recession, stock L will have a -10, and in a boom, it will have 70%. So you could do the same thing to see if you could find out the expected return. Okay. Actually, we have the summary here. So you could look at stock L and stock U, because we did already stock U. So this is the return for stock L, 80% times 20, 20% times 70. So the expected return is -2. Okay, and the risk premium is 10%. So if we take 26 minus 10 equal to 16, -2 minus 10, it's going to be -12. That's the risk premium. Well, we'll talk about this -12 later on at some other time. Okay. Now what we can do next, we can compute the variances. So we can compute the variances. And we looked at the variances and the standard deviation in the prior session, so I'm just going to go briefly over this. But if you don't know how to compute the variances, by all means go back and view the prior chapter. To calculate the variances of the return on our two stocks, first we must determine the squared deviation from the expected return. Then we multiply each possible squared deviation by its probability. We add these up, and the result is the variance. The standard deviation, as always, is the square of the variance. So pretty much you just have to follow those steps. But we'll work an illustration. Let us return to the stock U we originally discussed, which has an expected return of 20%. And in any given year, it will actually return either a 30 or a 10%. So the possible deviation, 30 minus 20 equal to 10, and 10 minus 20 equal to -10. So the deviation is 10 and -10. And what do we do with the deviation? We are going to square the deviation. Then we're going to take the squared deviation multiplied by the probability, just following the instruction. And the variance is 0.01. So the standard deviation is the square root of the variance, so it's equal to 10%. So the standard deviation of stock U, what we say, equal to 10%. Okay, again, we could do the standard deviation for stock. We did, this was U. We can do for stock L. Once again, the average is 25, so we'll take the observation. And how much does it deviate? Negative 20 from negative 25 is negative 45. Then we're going to raise it to the second power, which is going to give us 0.2025. We'll do the same thing for the boom. 0.7 is the expected return minus the average, equal to positive 0.45. Positive 0.5, we raise it to the second power. It's going to give us 0.2025, which is the same, because once you square something, it's going to be positive. Then you will take the probability, multiply it by the squared deviation. Then you'll find it's 0.1015, 0.1015, so 0.2025. Now, this is the variance, 0.2025. If you square the variance, it's going to give you a standard deviation for stock L of 45 and standard deviation for stock Q of 10%. Again, back to interpreting a standard deviation. What does that mean? It means stock Q is riskier than stock L. Stock L is riskier. Stock L is riskier than stock Q. Stock L has a higher expected return, but stock Q has less risk. Yes, stock L expected return is 25 because it will earn 70% in a boom. That's quite high, but you could also lose 20% in a recession. Notice that the investment in U will always pay at least 10%. So in U, it's good because in a boom or in a recession you should do good, but in a boom you don't do that good. Okay, but you don't go into the negative. Okay, with these, which of these two stocks you should buy, we really don't know. It all depends on your personal preference and risk tolerance. We can reasonably be sure that some investors would prefer stock L. So who would prefer stock L? Maybe risky investors. Investors that would like to take risks. Young investors. Investors that can't take risks because they could afford to lose. Who would choose stock U? Most probably conservative investors. Investors who are close to their retirement, or they are ready to be close to their retirement. Okay? So you have probably noticed that the way we calculate expected return and variances here, it's somewhat different from the way we did it in the last chapter. Somewhat little bit different. In chapter 12, remember, we were examining actual historical return. So we estimated the average return and the variance based on actual event. Here, remember, in this chapter, we're looking at the expected, which is the projected future return, and their associate probability. So we're multiplying by probabilities. So this information with which we must work. So remember, it's a little bit, the calculation is basically the same, but we're adding the probabilities. Why are we adding the probabilities? Because we don't know what the future looks like. We don't know what the future looks like. Therefore, we have to work with probabilities. And let's work one more example to make sure we know how to compute this. So going back to example 13-1, what are the variances of these two stocks once we have unequal probabilities? Unequal, you remember we said 80% recession and 20% boom. So basically, we're going to perform the same calculation. We're going to take the return deviation from the expected return. Okay, so negative 0.2 minus 0.02, and 0.7, which is 70% return, minus 0.02, because remember, this was the expected return for stock L. This is stock L, okay, and it was negative 2%. So it's the deviation is negative 0.18 and 0.72. Now we square the deviation. Then we'll take the probability times the squared deviation. It's going to give us this number. we'll do the same thing for this. We're going to give us this number. Then what we will do is we add up the product, then we find the square root of it, and that's going to be our standard deviation. Based on this calculation, the standard deviation for L is 36%, and the standard deviation for U is 8%. Still U, even with different probabilities, it still has a lower standard deviation than stock L. It has less risk than stock L. Okay, and obviously it should, because even stock L, the expected return, it's negative, because if there's an 80% chance recession, notice stock L, if there's an 80% recession, it's not gonna do well. But with an 80% high probability of something happening, well, actually stock U will benefit, okay, because stock U would earn 30% in a situation where there's a recession, and there's a high probability under this scenario that there's a recession. So obviously, if that's the case, it's going to have a lower standard deviation, higher expected return. Okay. If you have any questions, by all means, email me.